All right, so welcome back again. I think thanks for those who came slightly earlier. Now let's kickstart today's lecture. So today will be the last session that we have. I'm glad you guys must be happy that you have survived the 6 lectures or 12 weeks so far. Christmas is coming as well. So pretty fun. So for today, the plan will be first we'll do the lecture, all right, and then we'll spend the remaining time after the lecture, which I believe you two will have some time to go through, first of all, the GBA, and then subsequently we'll do any clarification regarding prior lectures that you need. So hopefully you do have some questions, especially for lecture 1 because it's so long ago. And as you might have realized, actually lecture 1 is quite an important lecture for example, in your GBA, where you need to have quite a bit of qualitative kind of explanation. So if we do have any questions, we can go through that again. And that will be a plan. So 3 parts lecture. We'll do the GBA and then any clarification. So for those who don't know, I think I've released the GBA and even the class participation marks. So I actually wanted to release the GBA marks earlier, but we do have, unfortunately, quite a few groups that require some kind of peer evaluation because of free rider issues. So I believe some groups have received various emails from the school, and the school is handling that portion of the moderation of marks. So do not worry in case you feel that a certain member of your group shouldn't deserve that mark. Do reach out to me. I think most of the groups that felt that way already have reached out and I forwarded the email to the school. So the school will contact you directly and then they will adjust the marks directly on their end, right? So it's unfortunately out of my control, and they will just adjust the totals for that particular individual, right? So we can do a deep dive for the GBA after the lecture, and then we can see what can be improved, particularly because we know that interestingly the company chosen is kind of the same as your final assessment. So understanding on GBA will be critical. Right. So we'll do the same style in the sense that if it's okay, we'll do like 2 breaks, maybe 2 10-minute breaks between each part, right? So be careful with breaks as well. Okay, so let's kickstart today's lecture. So just a recap of what we have covered so far. So this is the 6th lecture, we have done 5. So remember the first lecture was purely qualitative. We did a lot of qualitative kind of frameworks, we did SWOT analysis, PESTEL, we talk about the economic analysis, company analysis, financial analysis, a lot of qualitative kind of analysis. Then for the next 4 lectures, we actually dive quite in-depth into the various methods of calculating the quantitative aspect of valuation. And at the end of the day, recall that for this module, it is purely on valuation, right? So how do you value the company? And if you notice, even your final assessment, the main bulk of the analysis is how do you actually value a company, right? And whether you have used the appropriate methods as well as substantiated your choices well. So for the last 4 lectures, we have covered things like we started with the dividend discount model, then we went on to the FCFE, FCFF, which is the free cash flow models, and then we did residual income model in the last lecture, as well as we touched a little bit on technical analysis, even though for the aspect of valuation, technical analysis is kind of not that important, right? Because technical analysis is more on trading, where when we think about valuation, it's more on fundamental analysis. It's more on holding the stocks for long term, or it can be an M&A activity, etc. Right, and so now this brings us to the last lecture, where we'll go back into more of like fundamental analysis, and we'll look at this thing called relative valuation. Okay? So what is relative valuation? So relative valuation, basically in a very layman term, as usual, I like to give a very like intuition, high level of understanding is that you calculate various ratios, right? So you calculate various ratios. It's almost like ratio analysis, but it's slightly different. So you calculate various ratios and you compare these ratios either to a peer group, um, as you can see here. Let me just pull out my pen. So you could compare it either with a peer group or you match it with an individual stock that's close, right? But that's just one way of benchmarking. Later we will see that there's this thing called a justified ratio. So there's a actual ratio and there's a justified ratio. And what's the difference? So in this difference between actual and justified ratio is the crux of relative valuation, right? If you are comparing with median and closely matched stock, this is kind of like financial statement FSA, right? Financial statement analysis, which is what we have talked about in lecture one. So relative valuation is really more tilted towards calculating actual ratios compared with the justified ratios. And the justified ratios would later you'll see kind of link back to the uh, quantitative models that we've covered, right? So at the end of the day, we want to decide whether a stock is overvalued, fairly valued, or undervalued, right? So that's relative valuation. So the idea being, okay, you calculate some ratios, you compare the ratios between certain things. So the actual ratios compared with something, and then after that you determine, okay, this is undervalued, okay, this is overvalued, right? And intrinsically by itself, if you realize already, calculating some numbers and comparing it like this have its drawback, right? Because you're just comparing numbers. You're not really taking into account a lot of other aspects. So later we have to look at some criticism of using relative valuation as well. All right. So the idea of why relative or how relative valuation came about is the idea of one law on price, meaning what? If two companies are identical, right? Then the two companies should be valued the same. Of course, we know that this law of one price is in a perfect market because we know efficiencies, things might not be like this, right? So there are a lot of adjustments, so I would say, that need to be done. So let's see, it's most widely used approach in as analyst report valuation judgment. Fine. So if it's undervalued means that you perform well, as we know, where we always like to find a undervalued stock, right? Then where it's undervalued, we buy. When it's overvalued, we sell, right? So that's the idea of it. Okay, so there is this portion here that explains that, you know what, if the market itself is not efficient in the sense, let's say the whole market is overvalued, then overall, even you find an undervalued stock, then it might not really be truly undervalued, right? If the whole market itself is already overvalued. So, again, this points back to what? This points back to doing a robust kind of qualitative analysis about the market. That's why there's a lot of focus on doing economic analysis, a lot of focus on doing industrial analysis, right? To understand the market in the first place. So if we know that overall the market is inflated, then we need to do some adjustments here and there in our relative valuation as well. So recall that we always start with some kind of qualitative qualitative kind of analysis to give you some background of foundation before you dive deep into whether it's relative valuation or cash flow model. Okay, so this is slightly what I explained earlier. Relative valuation using multiples and this discounted cash flow are two different approach, okay, but they are mathematically related. And this is where, because they're mathematically related, this is where we can do the actuals versus uh, justified, justified uh, ratios, right? So the justified ratios uh, is from the DCF, discounted cash flow model, and we'll see this later. So by comparing the actual versus justified, we are able to say, hey, you know what, this stock overvalued or undervalued. All right, to do relative valuation, what do we need? So these are just some criteria. We need to identify comparable asset um, and obtain the market value of the assets, convert the market value to standardized value. We'll see what does this standardized mean. We'll use various ways to so-called standardize the values. Okay, so you compare a standardized value, but you have to control any kind of differences that we notice. And so what do we mean by this? It is basically things like doing adjustments to your let's say your financial statement before calculating the ratios, right? So this goes back to lecture one where we talk about certain adjustments that are required. For example, if there's an impairment, and you believe that in the future this impairment will not happen, right? Let's say if it's a COVID-related impairment, and you foresee that it will not happen again, then you should add back the expense, right? Impairment is expense, to add back the value of impairment, right? This would boost your bottom line at the end of the day, and of course impact your relative valuation as well, yeah, or any ratios that you compare. Yes, perfect. Yeah, that's true. There is no right or wrong way, and that's where even in the if some of you all eventually decide to join investment banking, corporate banking, or even like credit related roles, this is where your human capital, I'll call it, or your work experience actually adds to your value or your value proposition for your own self, right? Because at the end of the day, there is no right or wrong, and it's how you justify it. And of course, the more knowledge you have of the market, of how people generally do the adjustments, you kind of have more and more ways to justify the right and wrong way. But generally, there is no right or wrong. You just need to really justify why you do some adjustments. That's perfect. Yeah. Okay. At the end of the day, we can judge whether asset is over or the value. Okay. So we just on the onset want to identify some problems as well before we jump into actually doing the relative valuation. At the end of the day, it's very hard to find a comparable company. Especially companies that are very big, right? Remember in our GBA we had Sembcorp. So Sembcorp is very hard to find a comparable company to Sembcorp because Sembcorp has many segments. It's almost like a mini conglomerate. I wouldn't really call it a full-fledged conglomerate. And a lot of its activities are being shifted from historical, more shipping related kind of industry towards more, sustainability related. But at the same time, they do maintain quite a bit on the shipping and stuff. So, sometimes it's very hard to find what is a comparable company to Sembcorp, right? So it's quite tough. Okay, so adjusting price multiple for different fundamentals kind of quite tough. Uh, so this is where where I think one of your friends mentioned, right? There's no right or wrong. You really need to justify. So it can be quite difficult because it's a judgment call, right? There is no right or wrong way to do it. Uh, and when we think of relative valuation, we actually kind of use the market price quite a bit. And so if the share is not really fairly valued, meaning the market is not efficient, and in most cases not. For example, during let's say a war, right? Or like now we have the a war in Israel and Palestine or Gaza. So when you have this kind of issues or big geopolitical risks that is happening at the moment. This kind of risk, particularly for geopolitical risk, it's really tough to be priced in by the market, right? So the market generally price in things like credit risk, right? They generally pricing credit risk, things like credit risk or default risk. So things like credit default, counterparty risk. So things like this are easily being priced in by an analyst. And even yourself, right, when you do a valuation, you can kind of price in this kind of thing of, equity risk premium or country risk premium. I think some groups that did very well really did the country risk premium calculation, etc. So all these things are very easy priced in. But if you're talking about things like um, geopolitical risk, right? How do you actually price that in? It's not really very tangible per se. And so if you know that the market is experiencing some geopolitical uncertainty, then the question is, do you think the market really priced in the geopolitical risk into the market price? And most likely is no, or even if it's yes, it's priced in inefficiently. And therefore, if we use the price in the market at that point of time, perhaps it might not be a good reflection of a fairly valued stock. All right. So, we do have uh five multiples that we look into, which is good because there's not too many. If you do a Google search, you can find a lot of many more relative valuation ratios and multiples. But for the purpose of this course, we are focusing on five of them. Of course, this gives you more focus. At the same time, more is expected of like the explanation and stuff, right? Especially when you use these five valuation multiples. Okay, let's look at the most common one. We call it the PE ratio. I believe uh, probably most of you all have heard something about this before. Yeah, the PE ratio. Yes. Yeah, okay, I believe. Believe so. So yeah, okay, yeah. Uh, all right. So the thing is, we have two parts, right? We have market price. So P is price divided by earnings. So market price per share divided by earnings per share. Um, and the number of variant to this, and we'll see what does this mean. And when we think about price, usually we have the current price, right? Or sometimes you use the average price for the year. And then in terms of earnings, that's where we can change that. That's where we have variations already. So let's say we want trailing PE, trailing meaning that is trailing at the back, right? So you use a past 4 quarters, let's say earnings, so past earnings. And if we take the current market price divided by past earnings, that's where we have your trailing PE. Now, if we take our expected earnings, so what's expected? Expected means forward looking, right? Maybe forecasted earning. That's where we get our forward P. And so generally, as you really realize that when we do valuation, and in this sense, relative valuation, right? Relative meaning you're comparing something. Relative valuation, we want to you want to have a forward-looking type of valuation analysis. And so forward P is usually the more favored compared to a trailing P. But of course, the tricky part about forward looking again now is how do you do the forecast, right? So it is now kind of your job to do the assumptions, do the forecasting for forward, maybe 3, 4, 5 years kind of um, earnings in order to calculate your forward P. So there are different ways to compare the PE with its own history, other companies, or its own fundamentals. Own fundamentals meaning, let's say, use the justified uh, right? Okay, so here's just a quick kind of explanation. How do you even calculate the PE? I don't think it's too difficult, but let's understand how it works. Okay, let's look at the first one. We want to calculate the PE based on the next 4 quarters, right? So we have our price given here. So we have the price already, right? So now the issue is calculating the earnings, which is the denominator per se. So we want the next 4 quarters. What does this mean? It means that we are going to add up what's the next 4 quarters? So now you are at November 2011. So what's the next 4 quarters going to be? So it is going to be the December one, right here, the January, March, and June. So it's given here like this, right? So next 4 quarters. And then in the same sense, we can find what is the next 12 months, right? So remember, PE is just price by the earnings. So going back to this, we just take the price, $20 divided by the average earnings for the next 4 quarters. If we want the next 12 months, we can simply take the fiscal year, fiscal year 11, which is the next 12 months. I'm sorry, no, next 12 months. So next 12 months. So we take the, let's see, where's the next 12 months? Okay, next 12 months. Because the fiscal year is for the whole year is 1.1, right? So we know that we have one more month to go, December. So we take 1/12 times 1.1. And then we know that for the next fiscal year, the total earnings will be 2. So, and we know that there will be 11 months. So we take we portion it 11 divided by 12 times 2. And so that's how we get the next 12 months. This is earnings. And so we take the price divided by earnings. Then we have the current fiscal year. Current fiscal year, we just take 1.1, and the next fiscal year, take this 2. So this is just basically a kind of explanation of how you do the calculations for P. Maybe at this point in time, 2 questions so far. All right. So I think usually for relative valuation, the calculation itself is kind of simple, but I think it's more the explanation. Yeah. So it depends on what we are looking for, whether it's a forward-looking forward PE or trailing PE, right? So of course, like all these figures here are kind of like forecasts, right? They are forecasts here because we are at November 11. So all these figures given here are kind of like forecasts. So this is like more of the forecast. And then of course, these are like the historic. Okay, so there are some strengths and weaknesses that generally is being criticized of using a PE ratio. So the strength, of course, earnings is the primary driver of share price. It's widely used by investors. It's actually the most commonly used relative valuation. Convenience, of course, to capture the valuation in single number. Of course, this is its downfall as well, because how can you capture company's valuation in just one ratio? So the weaknesses is that earnings can be very small, it can be negative or zero, right? Because earnings, what's earnings? Earnings is profit after tax, right? Generally, is profit after tax. So it can be negative, it can be zero. It's not uncommon. And when it's negative or zero, it has no meaning already, right? So when it's a negative or zero, do not use the PE ratio. There's no point. We generally use this thing called the PS ratio, which we'll talk about in I think the last ratio that we will cover today. So price to sales ratio. If it's negative, if earnings is negative, you generally use the price to sales ratio. Managers, of course, have the discretion to determine what kind of earnings you reported. In this sense, remember things like accruals, right? How much accruals is being charged. We have things like impairment. So impairment also would bring down your earnings. Of course, we have things like depreciation. So all these things are like items that the managers can control, and in a sense, it will impact your reported earnings eventually. And in that sense, you can say like, oh, they can kind of manipulate the PE ratio calculated by investors. So we have mentioned this a couple of times that comparability of the P across different firms is kind of tricky, right? Because are you really able to find a firm that is 100% comparable? Perhaps not. And of course, there are issues to consider like growth rate, risk, accounting methods. If you notice that the P ratio do not consider any risk, right? Did we use any cost of capital? No, right? Remember, cost of capital is what? Your cost of equity, cost of debt. We do not talk about any of those in your calculations, right? Those is remember all your free cash flow valuation methods. So we don't consider the various risk or the cost related to the risk. We don't even consider the sustainable growth rate, or even the type of accounting methods, right? Are you using US GAAP or IFRS? So these are things that, of course, there are some weaknesses in using purely the PE ratio. Yeah, so we need to do some adjustments to make the figures more fair. However, let's say if we are using relative valuation, we do not only want to use one ratio to say, oh, okay, based on P ratio alone, we say the stock is overvalued, undervalued. Typically, we want to use a aggregate of, let's say, 3, 4, 5 ratios to if all 5 ratios say that, hey, this stock is undervalued, then there is strong justification, right? And let's say if you do your discounted cash flow model as well, then if your discounted cash flow says undervalued and all three relative valuation ratios, right? Let's say they pick 3 out of 5, all 3 of them also say it's undervalued, then you have a strong case to say it's undervalued, right? So that's how we use these ratios. Okay, so now what we are doing here. So just now we are calculating the actual, right? Actual meaning we are plugging the numbers from the financial statement. Now, what we are doing here is we are doing the justified. So remember justified? Remember at the end of the day, relative valuation, just at the start of the lecture, we say that we want to compare the actual versus justified. So now we'll calculate what is justified. And the justified ratios is just a fancy term of how do we bring in discounted cash flow model into the relative valuation. And then by bringing the discounted cash flow model in, you are basically comparing what? You're comparing discounted cash flow model with actual numbers from the financial statement, right? So if you do that comparison, you can see how you can do you can use the discount cash flow model as like the base, and then you compare it with the financial statement, and then if there's a difference, you can say, hey, this is undervalued, this is overvalued, right? You can see how the comparison makes sense, right? So one is based on discount cash flow, one is based on actual numbers in the financial statement. So that's what we're trying to do here. And so to bring in the idea of the discounted cash flow model into the relative valuation, what do we do? So on the onset, I want to just mention that in the next few slides, for all justified relative valuation ratios, I'll show you how to derive the final justified ratio formula, right? In this box here. However, you do not need to know how to do it, right? It's just for understanding, to show you that, hey, you know what? There's actually a congruence. There is a similarity between the relative valuation and discounted cash flow, right? So that's the idea of it. So you do not need to show the proofs of how you get it in a situation where you need to use the justified ratios. Just take the formulas and calculate directly. Okay, so let's start off with the dividend discount model as we know here. So anyone remember what kind of formula this is in terms of time value of money? So what kind of formula, in terms of time value of money, what kind of Is it annuity? Is it what kind of thing is it? Forgot which one. No, it's not annuity deal. So it is a anyone want to get? No, it's not growing annuity. What maybe one more person want to give it a try? It is a growing is correct. Yeah, growing is correct. Because there is a G, right? So it's growing. It is a growing perpetuity. Yeah, yeah, you're right. Yeah, growing perpetuity. So hope you do recall. So of course, remember we try to link everything up, right? We try to link valuation with time value of money, and now we are linking um relative valuation back to time value of money as well. So it is a growing perpetuity. Recall that for growing perpetuity, we need a D1, right? So and we know that what is a D1? Dividend at year one, right? So dividend year one is dividend year zero times 1 plus G, which is the growth rate here. Now, having this formula here, what do we do? We say, hey, you know what? How about I divide both sides by E? E meaning the earnings at year zero. All right, so we divide earnings at year zero here, and then we divide here as well, right? You divide here, you can put it like this. And then what do we realize? We know that dividend divided by earnings gives you what? It gives you the amount of money that is being distributed, right? It gives you the payout ratio. Hope you recall what's a payout ratio, right? The payout ratio. And what is payout ratio? Payout ratio is 1 minus B. What's B? Retention ratio, right? Retention ratio. So what's being retained? Remember? So 1 minus what is being retained. So payout equals to 1 minus retention ratio RR, right? Recall this. And payout is payout dividend ratio. So payout dividend ratio is 1 minus the retention ratio, whatever is being retained. And so we know that D naught divided by E naught equals to this. And so what do? We simply substitute this portion here with 1 minus B, right? And so we get this. And so this is what? The trailing PE, justified trailing. Why trailing? Because we are looking at P naught and E naught, meaning the uh the past, right? So it's trailing. Anyone need me to,
Sorry, I have a question with regards to the dividend payout ratio. So in regards to calculating the dividend payout ratio, right? Normally would it be using the total dividends that are paid out and then you divide by the net income, or is it by using like the dividends per share? Then you
okay. So you can use both. So you can use total dividend divided by total net income, or you can use dividend per share divided by earnings per share.
The answers are like different.
Yes. So the answer is different. So because you know that for dividend per share, dividend payout per share, because you know dividend is usually paid out twice in a year. There's one in June, and then one is being declared and paid usually the next year. If you notice, that's how usually dividends being paid. So the right way to do it is you take the dividend that is being declared and paid. Okay, so you must really look at a company. Some companies three types. Okay, let's see what does this mean. So this goes back to a bit of accounting. Okay, so let's do a timeline here. Okay, so this is 2022, let's just say last year. And generally a financial statement, so this is December, all right? Normally they release their statement in March, right? So March of this year. So we have at March of this year, what happens is that they'll have a dividends declared DD, right? And then they will say, hey, you know what, we are declaring dividends, but normally it's only paid out in, let's say, June, right? June of 2023. So dividend paid here. So you have a paid amount. Now, in June, normally what happens is that they will also have a dividends declared. But it's only declared, meaning that in the financial statement of FY 2022, right? Because remember, March is where the financials, the FS is released, right? So in June, when they have a dividends declared, it will not appear in the financial statement of FS 22, right? It will not be a will not it will not be found here because it's declared in June. But it will be paid out. What happens? It will be normally paid out in December 2023. So what does this mean? It means that you will actually have to consider the dividend declared in March, this is reflected in the financial statement, that's fine, as well as the dividends declared in June, which is paid out in December. So this is one example of how the dividend, yeah, correct. So interim and final, that's right, correct. But the tricky part is that your annual report. So what I'm trying to highlight here is your annual report here might not capture both the interim and final dividend payout for the fiscal year, right? So you got it? Because you see, your dividend declared here is not captured in your financial statement. So going back to your point, that is why you notice that the numbers are very different when you use total dividend from the financial statement divided by net income, or you use the dividend per share divided by the earnings per share because of the different timing in dividends. And so, of course, let's say, let me just. So, of course, you know that this would snowball, right? Let's say 2024 March. So this will snowball, right? So March, let's say there is a dividends declared, and then they also have a financial statement release of 2023. So what happens now? Can you see that when they release the financial statement in 2024 March, the financial statement would capture what? This dividend here in the financial statement, right? This dividend that was declared and paid in December already. However, because they have not paid this dividend yet, it might not be captured, right? It might be only captured in June when the interim financials are being generated. So there's always a lag because of the way dividend is paid. But this is, of course, not all companies do that. Most companies have this interim and final dividend, but the dates are different. So you need to be very careful on the dates.
Understood. So in the case where which method would be best for calculating the retention ratio in this case? Is it by using the dividends per share divided by the earnings per share, or by using
Mm,
the net
I
income?
would Okay, yeah. So actually both ways are okay, but normally, okay, so in the market, right, what usually people do is they use dividends per share divided by earnings per share. However, the dividend per share, they generally take a average, let's say an average of the two dividend periods.
Two dividends period, meaning like the one that's within the year, or
So if you are going to assess, okay, so let's say if you are assessing which year, so if you are doing FY 2022, right? So assessing FY 2022, you need to consider all the dividends paid in 2022. So That means from January to December of 2022, whatever dividend that's been paid, you should consider that.
Paid
Meaning
meaning
that,
the cash is already out, or
yeah,
does it
cash is
include
out.
those that have been declared as well, but haven't paid yet?
Okay, so that's where, okay, this is a very interesting question. So this is where adjustments come in. Like what your friend mentioned earlier. So if it's been declared in 2022 as a, this is where judgment come in. So there's no right or wrong answer. As a conservative analyst, you consider it. Why? So let's think about it and understand why. Okay, so let's say in 2022 December, okay, they say, okay, you know what, we're going to pay dividends of, let's say, $1 in 2022 December. Now the question is, should you consider it in an analysis of a company in 2022? A conservative analyst will say, yes, we should consider. You know why? Because they have declared, they confirmed to pay, regardless of even your cash flow, no money, whatever, you have to pay, you have declared already. Right? So that's a conservative analyst who say, okay, I'm going to consider it. However, as a more I would say aggressive analyst, right? You'll say, hey, you know what? Because you have declared it in December, but you owe the cash flow is only going to flow out next year. I should not consider this outflow of cash flow in advance of 2022 because it's only going to outflow in 2023, right? So it depends on how you justify. You understand? Does anyone understand
Yep,
this?
understood. So it really
Yeah,
depends on how you want to present
just
your
yes.
understood.
Yeah,
Thank
but
you.
you understand the idea behind it, right? Why
Yep,
you can actually consider and why you might not want to consider.
understood. Thank you.
All right, that's a great question. Okay, so we do have a few questions here. Let's just see before we carry on. Yes, so we need to consider the dividends. Let's say in this example here, right? We want to consider the dividends paid in 2022. Yes, so you need to consider both. But we need to be very careful which year is being paid and which year is the dividends for. Because in the financial statement, later we can go through and try to understand dividends in terms of the financial statement. But you notice that when it's being reported in the financial statement, most of the time is the year prior, is the bad year. So you need to take the you need to exclude that and include the current year, something like this. If you study the financial statement. Okay, so you do have a question about, okay, the snowballing effect will take is still good enough for the future estimate since the difference in time. Okay, so yes and no. So this comment is a bit dicey, I'll say. Why? Because the thing is, when you're doing a valuation, right, you are valuing the company as of this year, right, 2022. So as much as possible, as a good analyst, you want to include as much information that you think is relevant and exclude whatever that's not relevant. So if you say, hey, you know what, because it's going to snowball, unless you're doing a valuation every year, right? Uh, then the snowballing doesn't offset, so-called offset each other, right? Because if you're just doing the valuation as of 2022, and let's say the valuation is for M&A in 2022, right? You want to do M&A in 2022, then you need to make sure that your valuation in 2022 consider all factors already, right? So yeah, hope you understand this. Yeah. So it's really how the valuation is done in that year. Yeah, as long as it's in a fiscal year. So, it gets even more trickier when the financial year end for companies are in March, right? If it's in March, if it's January to December, like if the financial year ends in December, that it's kind of easy. But when it's March, then that's when it's overlap for next year, and then we need to consider uh, uh this 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 thing here, this thing. So I highly recommend that if you're confused, to draw a timeline and then put down all the dates, declared, dividend paid, dividend declared, because usually it's being declared, then it's being paid, and then we see which portion of dividends is within the year that you want to analyze, and then that's how we determine the dividend. All right,
Sorry
and then
to
yeah,
intrude again. Just another question. So what if the dividend payout ratio using the DPS over EPS, right? It's more than 100%. So how do you find the retention ratio in this case?
okay, that's a good question. Let's see. Uh, so dividend payout is more than 100%. So then we need to look at the financial statement. Is it true that they are really paying out more than the earnings? So that means, okay, so if this is the case, then we need to investigate some more, right? Is it your calculation is wrong, or is it true that they actually pay out more than the earnings? Um, how do you investigate? It means that if they are paying out more than their net income, means that there is no retained earnings for that year. That means there's no earnings being retained. So you want to check, is that true? There's no retained earnings. Generally, it's kind of a red flag. Um, and most of the time is because maybe certain calculations it's not correct, or you need to do some adjustments to, like, let's say, the impairment, or things like depreciation.
Understood. But then I went to double check online and with
Mhm.
my calculation, and it aligns for the DPS over EPS. So, but then the
So
net
they
income
pay out
over
more.
the retained
Uh-huh.
earnings, sorry, the dividends over the net income one, it is significantly lower for its retention ratio. As in for its payout ratio, it's significantly lower as compared to the DPS over EPS.
But is it 100? Is it 200%, or is less than
Yeah,
100%? For
it is the
more than
DPS.
100%.
Yeah, it's over 100%. But then if I use the net income method, it's about 13% only, the payout ratio.
Okay, then maybe a 30% feels more correct. Uh, I might you might want to see. Okay, so this is a bit out of the scope of this module. I think because they expect you to really know this. Earnings per share, right? EPS. So EPS is a very uh difficult topic in accounting. Uh, does anyone know what's diluted EPS and undiluted EPS? Anyone heard of it before? Dilution?
Is it like
Yeah,
it includes certain shares where they account for certain
correct,
shares,
correct.
right?
Yeah, so when you plug EPS numbers, right, especially financial report, you want to go into the notes to financial statement to see what number is being, what number should be used, whether is it the diluted EPS or the undiluted EPS. Generally, we want the if we are conservative, we want to ensure that to take the diluted one, and this might impact your calculation of this. So yeah, you might want to investigate a little on this part of EPS side, uh, how the EPS calculated.
Understood. Thank you.
And I want to share with you again why this is very pertinent is because when you have financial no instruments, right? Complex instruments such as your convertible bonds. Convertible bonds. So there are quite a few different kind of bonds. There's convertible bonds, there's mandatory convertible bonds. There are treasury shares. There are even different layers of shares, right? There's like sometimes it can be common share, it can be preferred share, right? So you want to be very careful for EPS, right? The EPS, you need to check the notes of financial statement. Did they assume a conversion of the convertible bonds, which would dilute your EPS? Or if no or yes, then you need to determine whether it should be the case. Yeah, there are different tiers of shares. So that's why EPS can be a bit tricky. Now, of course, when you see a payout ratio more than 100%, this is a red flag. You should stop and then you go back and check. And if you realize, hey, you know what, maybe if I use just dividends divided by earnings, that give me kind of a more reasonable type of payout ratio, and it's congruent with what you have seen in other valuation platforms, right? Like now I know you don't have FactSet, but you do have um, another platform. It just slipped my mind. Someone asked me, I think,
Have
you have
IQ.
another, as a Capital IQ? Yeah,
Yeah.
you have Capital IQ? Yeah, okay. So now you have Capital IQ. So yeah, so if you use Capital IQ, they give you somehow some form of uh, payout ratio, and if it's kind of congruent to this Capital IQ payout ratio, then you know you're kind of on the right track, right? Of course, if it's more than 100%, I'll say it's a red flag. And you should stop and consider whether it's true. Because normally it shouldn't be for a mature company.
Understood.
Okay,
Thank you.
so well, most welcome. Okay, so we had quite a bit of discussion on this. Refinitiv is good. Actually, Refinitiv is a very good platform. I don't know how you got Refinitiv because you need a special you need a monitor, right? Yeah. Oh wow, really? Okay, so I know Refinitiv is quite similar to Bloomberg, where it is a station, meaning you can't access it on your laptop, which is a bit of a bummer because it's a bit troublesome. You have to go to school to access. I think even the school has Bloomberg, right? But you need to go to a terminal to do it at the library. Um, but yeah, Refinitiv is very good. I think Bloomberg and Refinitiv are the two best because they're expensive also. Okay, so let's move on to just now we talk about the the trailing PE, right? Trailing PE. So now let's go into the leading PE. So leading PE, in the same sense, the justified version of the leading PE. So how do we do this? So justified version of leading PE. Again, we start with the growing perpetuity, all right? And then how we formulate it is slightly different, right? Because we are already at D1. We know what is D1 is dividend that is paid, right? So dividend that is paid equals to what? Earnings times payout ratio, right? Earnings at year one times what is being payout ratio. And payout ratio is 1 minus retention ratio, 1 minus P, right? So by putting in this portion here into the formula, and then after that, dividing both sides by E1, we can get the forward or leading justified P. All right, so remember at the end of the day, you just need to use this ratio. You don't have to do the proofs. This is just to explain to you really how we got it. I think in the main lecture, like other lectures, this is not included. I kind of included all the derivation more for explanation purpose so that you really understand the ratio. All right, so the same sense we can compare the justified PE with the FCFE. Remember why we compare FCFE and not FCFF, because PE is relating to just the R, right? R here. R meaning the cost of equity. Therefore, we are focused on the free cash flow to equity holders. So we do have this again as the growing perpetuity, but now instead of dividends at the top, we use the FCFE. Okay, and then we simply divide by the earnings per share, right, to get PE. And if we divide by earnings, we similarly divide by earnings, and so this is the justified PE ratio based on FCFE. Now, let's have some comment on the PE ratio, right? So, high growth firm will have high PE. So, these are just some comment, right? Why? remember, price to earnings, right? You're comparing price to earnings. So if the earnings is, let's say, $100, but the market price it at $200, means what? The market feels that, hey, you know what? This company is going to increase the earnings to 200, right? Remember, it's all about the ratio, the meaning of the ratio, right? Because when you use a P ratio, we want to explain. So it shows that if the P ratio is high, means that company is going to grow a lot in the future, right? Because the market is thinking that, hey, the company will have $200 of earnings in the future, right? So high PE means high growth. All things equal, a high risk firm will have low PE. So how does this work? A high risk, so imagine a high risk firm, right, is a firm that, let's say, a startup, they grow very fast, they have a lot of earnings, right? So when the earnings is very high, your denominator is very big. And therefore, a big denominator with the price being low because the market says it's too risky, I'm not going to 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 um to award you so much. So the price is low. That's where your PE becomes low. Now, the last point is if there's a low reinvestment need, the PE, there's a higher PE. So how do you think about this? If there's a low reinvestment need, so that means that, so reinvestment need is, for example, capex and stuff, right? So if more of the value of the firm is being distributed out to the equity holders, so there's low reinvestment need, right? Everything is being distributed out. Means that your earnings, your price will be high, your earnings would be the flat, right? Whether it's not high or what. So therefore, your price being high would push your PE to be high. Now, because of these three competing points, it's sometimes very difficult to assess the firm on a pure PE basis. Why? If the growth of the firm is high, right? Generally, the risk is high, correct? But can you see the P ratios are going in separate direction? If the growth is high, the P is high, but the risk is high, the P is low. So what happens if it's a high growth, high risk firm? Your P ratio would be net. You net off. So it might be just average P ratio. So because of that, sometimes P ratio can be quite difficult to really ascertain the uh, the level of the firm at that point of time. Yes, it can be a bit misleading. So that's why at the end of the day, for relative valuation, we try to use multiple ratios, right? Don't just use P. Yes. So when we say about high, have a high or low, remember we refer back to either a peer that is very similar to your company, or you use the industry median to compare, right? So remember, flip back to the start of the slide. Yeah. Okay. So let's look at this example here. Um, this is just a simple example. Question will give you retention ratio, growth rate, and required stock price. As you know, you'll never be ever asked to do this. It's just more practicing how to do the calculation. So if we want a forward-looking PE, right? So this is a forward-looking PE. So you just take 1 minus B, you just plug in this formula, you plug in the numbers, you get a number here, right? And this is what? This is the justified, right? Remember what you're calculating, huh? This is justified. So we are going to compare the actual with the justified. So let's say the actual, okay, if the firm's actual is higher than the justified here, means what? The stock is over value compared to the justified. Everyone understand this? So if the actual, so what you have calculated here is the justified. If the actual meaning based on the financial statement is higher than the justified, means that your stock is overvalued. All right. So next one, we have another example here. We have this company. We know that the long-term payout rate is 50%, growth rate is 5%, required rate is 9%. What is the justified leading and trailing? So we want the justified and what's the leading and trailing P. So again, we just plug in the formulas. So just remember, pick the right formula, and then we calculate this. Okay, I think it's about time to take a break, but let's finish these two slides first. P ratio and PV. So what does this mean? P ratio and terminal value. So recall now we are at the part of terminal value of a imagine a dividend cash flow model, right? So generally the terminal PE, we use the industry or medium PE of the firm on historical PE, calculate the terminal PE. So it's ground out market data. Disadvantage is that if benchmark is mispriced, so of course if the median or whatever has a bit of mispricing, how does mispricing come about? Meaning like there's a black swan event or something happened, and so like that year is like exceptional year, right? So if it's mispriced, then your terminal value is mispriced. Calculate terminal value using fundamentals and variables. So what does all this mean? So recall now we are in the area of terminal value, right? So that we have this example here. And for terminal value, typically want to use the median or industry averages to calculate the terminal value of using the PE, terminal value. Okay, so this is the question, right? So we're given all this. So value of the firm, required return is 11%. EPS forecast for 3 years. Remember, forecast meaning that is the forward looking is 2.5. What else? Now we have some peer industry groups here, which is good. We have the mean dividend payout ratio, we have the mean ROE and mean PE. So all these are given, and these are industry groups, right? All right, so let's start off with doing the calculation for the payout, the retention ratio. And so we know that the payout ratio is 0.4. So what is being retained is 1 minus 0.4. All right. And what is the earnings per share? Let's see. Okay, earnings per share is this, and we know that we are going to pay out 0.4, means what? So we can calculate what's the dividends being paid out, right? So we know that dividends being paid out is $1 based on these two information here. Oops. And so remember we are at the level of terminal value. So recall that in most cases, or what we have learned in the course is that for terminal value, we assume a growing perpetuity, right? Growing perpetuity forward. So using this concept of growing perpetuity for terminal value, we just plug in the growing perpetuity formula, which is D3 times 1 plus G divided by R minus G. So we have this value here. So we have calculated the TV of this firm. Everyone okay? Until this point, everyone's okay? Okay, okay, very good. We are all following. Now, what do we do now? So remember, we are in the scope of relative valuation, right? Relative, right? So we have calculated the terminal value based on dividend discount, right? Dividend discount. Oh, sorry, not discounted cash flow (DCF), right? Here is terminal value on DCF. So how do we calculate the terminal value based on PE? Very simple. We are given. Remember the earlier slide. We say that we should use the median or industry average. So we have been given the PE for the median, and we know the forward-looking EPS. So we just multiply like this. Price per share times earnings per share gives us the price, and this is based on relative valuation (RV). So now with a value based on discounted cash flow and a value based on relative valuation, we can do the comparison. Now, so is this firm's terminal value over or under? Okay. Okay. So you know what? Maybe at this point, let's take a 10 minutes break, if that's okay. So maybe wait, let's do it 8 minutes because now it's already 8:10. Okay, so let's be back at 8:18. That's fine. Before we move on to the next few ratios. And feel free to put in a group chat if you do have any questions in the meantime. So we're back at 8:18. Okay, break. Ah, okay, welcome back. Hope you had a short break with the toilet, some tea. Okay, so we have covered the first ratio in quite detail. You'll notice that for the next few ratios, they kind of are not so much in detail. Um, and we'll see why, because most of the ideas stack onto the first ratio. So the next ratio that we're going to talk about is this thing called price to growth ratio. All right, so PEG. So why does this ratio come about? Because we know that different firms in different sector grows at different rate, right? So by just using PE, we are not considering the growth factor, right? And what do we mean by consider growth factor? Meaning that we want to remove the growth of the firm so that we can compare the ratios accurately. And by removing the growth, what do? We divide it by growth, right? So the PE per growth unit. That's how we remove the growth factor here. Um, and so by doing that, we can then identify whether it's over or under value. So in general, the idea of using PEG ratio is that if the PE ratio is less than the expected growth rate, it is undervalued. So this is the so-called the principle. If it's less than expected growth, it is undervalued. So let's see some issues relating to this small comment here. First, there's no basis to believe that a firm is undervalued just because the P ratio is less than the growth rate. Okay, so this doesn't really explain much, but let's look at problem 2. The relationship may be consistent with a fairly valued or overvalued firm if the interest rate is high or if the firm is high risk. Okay, so what does this mean? So recall how does the firm price in interest rate risk? Anyone can't remember this? Okay, let me just jump back to this to kind of explain to you how does this work. Okay, so we have, remember, interest rate risk is priced in by the interest component, right, in the financial statement. So higher the interest rate, your cost of debt increase, and with your increasing cost of debt, your interest increase, right? Everyone understand this part of interest rate? So, okay, so we have the PE ratio divided by growth, right? G. So what is the derivation of PE? So PE is price divided by earnings, right? And what is growth? Growth is return on equity times retention ratio. So what is return on equity? Return is earnings divided by equity. Okay, so we have just derived all of it. So let's look at go back to the slide. What does it say? Relationship may be consistent with fairly valued firm if the interest rate are high. Uh, okay. So if the interest rate increase, what happens here? Pen, if interest rate increase, earnings decrease, right? Interest rate increase because more interest, less earnings. When earnings decrease, your growth would decrease and your PE here would increase, right? And remember what is the so-called the what's it called? The approach, sorry, approach is that the firm PE ratio is less than expected growth is undervalued. Okay, when the P is less than expected growth. And if we look at here, if the interest rate environment is increasing, then less and less of the firm would be considered undervalued, right? Because the PE must be less than expected growth. But see, the PE is increasing, the P is increasing, and the growth is decreasing. So less and less of the firm will become undervalued. It means what? Remember, at the end of the day, we want to pick undervalued firm. It means that we are going to reject a lot of the firm. We will say most of the firm is overvalued. Right, and this is one of the main problems with using the PE to growth ratio. Right, everyone understand this part about how the interest rate environment affects the PE uh, uh, convention, PE to growth convention analyzing. Right, so in this sense, this idea that hey, you know what, if the PE is less than expected growth is undervalued, this might have a big issue, right? As we can see here, high interest rate environment. So if interest rate interest rate decrease, fewer stocks will emerge as undervalued. Okay, let's see how do we calculate the PE to growth ratio. So PE to growth, we just take PE divided by the expected growth rate in the earnings, right? So this is earnings growth rate. This earnings growth rate. It is so we can use per unit. It's per unit PE or expected growth, makes a stock. So it makes us being able to compare stocks with different growth rates. So generally, a lower PEG is more attractive than a higher PEG. So what does this mean? With a lower PEG means that the stock would grow more. Why? Because the denominator, so this part here is big, right? If this is big, means that the PEG will be small. So remember, at the end of the day, we are picking an undervalued stock so that the stock will grow in the future, right? We invest and then the stock will grow. So we want a lower PEG in this sense. So a big growth rate kind of firm. So all things being equal, a lower PEG is better. Of course, we just now already saw that there are a lot of issues like just simply using the PEG calculation and picking just the lowest PEG stock. So the risk and payout which affect the P ratio continues to affect the PEG ratio. So what does this mean? It means that whatever kind of issues relating to PE that we talked about earlier, it can also affect the PEG ratio, right? Now, at the end of the day, at the start of the PEG conversation, we say that by dividing the PE with expected growth, we kind of remove away the growth factor, right? Which allows us to compare stocks that are growing at different rate. However, you know what? Actually, it might not neutralize the growth completely because we have things like the growth at two stages, right? For example, if we are using a forecast of the growth earnings for the 5 years, let's say a 5 years period. However, the 5 years might be a high growth period. Then after the 5 years, it will be a low growth period. So because there are different high growth, low growth, it becomes a very complex calculation and therefore the full growth factor might not be considered in a PEG ratio. Now, an important part is it does not consider not factor in differences in risk. So this component of risk, again, we want to bring in things like, did it consider things like the cost of debt, cost of equity, right? Did it consider things like capital structure, right? Capital structure meaning how much of the firm is financed by debt, how much is financed by equity, how much is financed by preferred stocks. So these things are not considered part of the PEG ratio or PE ratio, right? These are the criticisms of the PE ratio earlier that we talked about, and similarly for the PEG as well. Now, the ratio do not account for the differences in the growth, duration of growth. So what does this duration of growth mean? So are you going to use 10 years growth rate, historical growth rate of earnings? Or are you going to use 5 years? Are you going to use 3 years? So how do you determine the number of years, right? So it is quite difficult to know how many years to use. Generally, I would say that if you want to use this ratio, you want to look at your investment horizon. So if you know that you're going to invest these stocks for the next 5 years, or let's say 10 years, then you want to match the growth horizon to that duration of the stock that you want to invest. So if you're going to invest in 5 years, you find a growth in the next 5 years. That's it. Or if you use historical, then you use the last 5 years. And because using different growth, obviously can affect how the growth growth factor is. As of course, if you go too far into to history, it might not be reflective of the future, right? So that is the part that you want to be careful. So there are further criticism of the PEG ratio, where you see that a high-risk firm would trade at much lower PEG than a low-risk firm. So remember the high-risk, low-risk, a few things, right? So a high-risk firm generally have a high growth rate, right? Meaning that the PEG ratio will be small, while low-risk firm generally has a low growth rate, right? So think about things like a utility company, right? Let's say Sing Power, compared to a very high growth company like Grab, right? So Grab has high risk, PEG ratio will be low compared to Sing Power, which the PEG ratio might be higher, right? Because the growth is smaller. So because of that, company looks most undervalued in PEG ratio based on the sector that the company is. So if you're going to compare PEG ratios between companies from different sectors, let's say Grab and Sing Power, it actually might not be too useful, right? Because they have different risk. So if a company is able to invest less for a better project, a higher return project, means what? If you invest less but for a more efficient project, the PEG ratio will be higher compared to a company that grow at the same rate, less efficiently. So basically, if the company uses its cash more efficiently, the PEG ratio will be higher, right? That makes sense because that means price to amount of growth will be higher, right? So company with very low growth will tend to be higher PEG ratio compared to average, and bias is worse for low growth stocks. So basically, what all this saying is that when determining the PEG ratio, so in summary, what does it say? It means that the growth rate is very important in the PEG ratio, as you have known that the growth rate is very important for the terminal value in your discounted cash flow model. And so when we want to use a PEG ratio, make sure that you are, first of all, maybe the same sector, the companies have similar project riskiness. We want to make sure that company has a similar level of growth, even though your PEG ratio tries to neutralize the growth, but you want to make sure that the growth are in the same stages, right? Remember, you have a business cycle, there are different stages of growth. You want to make sure that they are in the same stage as well, right? So you need to consider all this before simply just using the PEG ratio. Now, this is an example of what we have discussed. So we have a company with a PE, company A, PE of 20, company B, PE of 15. We have company A, growth 15, B, growth 10. So it seems like, hey, company A seems to be better, right? PE is higher, growth is higher as well. The company is going to grow more. So let's see, let's calculate the PEG ratio now. So we calculate PEG ratio company A, PEG ratio for company B. So can you see that while the PE is higher in, in company A, on a growth basis, company B is actually more expensive with the higher PEG ratio. You see, the PEG ratio is higher here. So because of the lower growth, it has caused the PEG ratio to be higher, even though the PE for company B is 15, which is lower than company A. Any questions at this point in time? No? Well, okay. Everyone. Okay. So we have 9 example here to calculate the forward PE, PG, and intrinsic value of the stock and determine whether it's over or undervalued. So we are given the peer groups here. We are given the subject firm. We are given the stock price. So PE ratio, right? PE is the price divided by a earnings, right? So in the next page we have that. So PE, price divided by earnings, and this is the forward because the earnings are earnings forecast. Once we get the PE, we can calculate PEG. We know that the growth rate is how much the growth? 8%. So we can calculate PEG ratio here. So what's the comparables? Let's see. We are given the median PEG and the median PE, right? So we can do a comparison. So what is the PE? So median P is 9, so your firm is 6.2. So you are actually lower than the median peer, meaning it's undervalued, right? In terms of PG, the median is 1.6. So you are actually, your calculator is 0.7, which is also lower than the peer 1.6, means it's undervalued. So see, these two has already provide you that, hey, you know what, it's kind of undervalued. So by using these two ratios, we can, I wouldn't say safely conclude, but we can somehow conclude it's undervalued, right? Of course, we try to use 1 or 2 more relative valuation ratios as well. Now, in terms of intrinsic value, we're asked to calculate intrinsic value. So we take the, let's see, we take, what's that? The PE, right? We're given PE times the earnings per share. What's the earnings per share? 4.5, right? So we take PE times earnings per share to find the value of the firm, like what we did, remember, for the terminal value question on PE. Now, so having calculated intrinsic value here, let's just compare it with our current stock price of 2.8. So it kind of, justify or support our claim, right? Our current stock price is kind of undervalued compared to our intrinsic value of the stock. All right, so moving on to the next ratio, price to book value ratio. So now it is very similar to price to earnings, but remember, price to earnings, we are using the earnings, basically the cash flow of the firm, or the flow of income of the firm from the income statement. But instead of that, how about we use the book value? And book value meaning the book value of the shares of the firm. So intuitively, if we have a book value here, right? So let's think about the idea of what does this ratio. So we have a book value of the firm. So the book value of the firm is basically what the shareholders think that the firm is worth, right? Because book value of firm is the equity component of the firm. Now, if you compare it with the price of the firm also is supported by shareholders, right? People that buy the stocks of the firm. So if there is a great variance between the uh, book value and the price of the firm, means that, hey, you know what, maybe the stock is undervalued, right? People are pricing it more than the book value, or is it less than it's overvalued? So that's how we use the book value uh, ratio. So you're going to compare what's the book value and compare what's the price in the market. So this is what I say, the price is where the investor is willing to pay at that time, whereas the book value uh, is what the investor paid in the past, right? So we want to compare the difference between the price now and the price in the past. That's the idea of the price to book value ratio. So the good things, okay, let's talk about some advantages, disadvantages. Good thing is always book value is positive, it's more stable than earnings, right? Because book value is kind of like what the equity component, right? Appropriate for firm that will terminate. So for example, if it's going to close in a couple of years, we can still use this. Weaknesses, it does not recognize non-physical assets and reputation, human capital. So what is this? These are more like uh, implicit costs. Remember we talked about economic profits. Economic profits. So when we talk about economic profits, remember is more of an economic concept where we need to consider implicit and explicit costs. So in this sense, it does not consider things like reputation, human capital, which are more implicit in nature. Can be misleading due to accounting practices. Recall that nowadays there's a lot of emphasis in fair value reporting. So we are moving away from more historical costs, we're going more fair value. And because of that, maybe your price to book value will no longer be that accurate anymore. Because if you're using fair value basically means somewhat equals to market value, right? Somewhat equals to market value. So recording assets as historical costs make it difficult to compare with assets of different ages. What does this mean? This of course means due to the depreciation that happens, right? Because assets are being depreciated. And so if you are doing record at different stage, it's actually very hard to compare. And that's why we have a move towards more uh, market value or fair value reporting. Right? So this is the ratio. Okay, so if you just take the market value of equity divided by book value of equity, this price to book value. All right. Okay, so this is an important slide because when you plug figures from the financial statement, you need to be very careful. When we talk about equity, right, we are most often simply talking about common share holders, right? So we are not considering preferred share. And let me explain to you why. So it's not just because, professors say we don't care about preferred share. No, the idea is that in most cases, go back down to the purpose of valuation, right? So in most cases, whether it's a question or let's say in the future you work for a company, right? And you're doing some acquisition, you're doing takeover, whatever. But most of the cases, you're actually acquiring common shares from of the company. So you are acquiring common shares of the company. You are typically not acquiring preferred shares based on the purpose of your valuation, right? So if it's an M&A, you are acquiring common shares, of course. If you are if you are, let's say, a hedge fund, or if you are a private investor, you also acquire common share, right? So most of the case, you are only considering common share. And this is the reason why, because of the purpose of your valuation. So try to bring back your valuation method or why you do certain things back to the purpose of doing the valuation. Why do you even do a valuation in this way? Right? I hope this makes sense to you. Bringing back to the purpose. And so in this case, or in most cases, we remove things like preferred share, senior claim account share. However, like as of all valuation, there is no right or wrong. So if you say, hey, you know what, we should include preferred share. And if you can justify why, maybe you say you want to acquire preferred share because of certain reason, then we should do it that way, right? So there's no right or wrong in this case. And of course, if you are using common share, make sure your book value per share using the common share equity divided by common number of common share outstanding. Again, we are using the justified, we need to be able to calculate the justified version of the price to book value. And we are using the growing perpetuity of the dividend discount model. So we know that D1 equals to E, remember we already talked about this, how much dividend is being paid equals to the earnings times the payout ratio, right? And payout ratio is 1 minus retention ratio. Okay, so we also know that E, earnings, equals to the book value. So let me just erase this a bit. Equals to the book value times return on equity, right? And so we plug in these figures into the growing perpetuity formula. We divided both sides by book value, which helps us cancel out this. So it gives us this. And then what do? Then we multiply it in, right? We do a bunny hop. Multiply in to get this. And we know that growth is ROE times B, right? And therefore we can plug in the growth factor here. So remember that at the end of the day, you do not need to know how to derive. This is just purely for understanding, to show you how actually it connects to your cash flow, the discounted cash flow. What is important is that you need to know that this is the formula being used for justified book value. Okay, so how does it relate to residual income? All right, so let me try to prove to you this. I did not show the derivation. I didn't show partial derivation, but let me show derivation here. So we have ended with this, right? Now, what if I do this? ROE minus G minus R plus R divided by R minus G, right? I plus R minus R is nothing. It's cancelled out. So what happens here now? Then I get ROE minus R divided by R minus G plus R minus G divided by R minus G. Everyone get this derivation? And so what does this equal to? This equals to ROE minus R minus G plus 1. So I have got this formula here. And this is very similar to your residual income model. So I'm going to flip the next page now. So I have derived this already here. Everyone get it? I have derived this. And can you see that because there is a plus 1 here, isn't it very similar to your residual income? Remember, residual income is the book value, which is this, right? Book value, and then you plus some residual income, right? Because the main portion is book value, and then you add in all the future income that you're going to get, the residual part of your income, of course, PV, right? So by then multiplying book value on both sides. So what's happening here is that you multiply book value here, they multiply book value here. So book value cancel out, and then you multiply it like this. You get this formula, which is the residual income model, single stage residual income. So it shows how the justified PE is related to the residual income as well. Okay, may I just pause here? Any questions, any clarifications as required at this point? Okay, so this is a simple example. Not much to talk about. Basically, it means that you have RO in the business, RO is this, required rate of return of this. You basically growth is this. Your justified PE based on fundamentals. You just plug the values in, right? For justified PB, sorry. Okay, so we have one more. Actually, two more. This is one. So what's this Tobin Q? So Tobin Q is your PB ratio. But remember, PB ratio, what you're interested in. You're interested in equity, right? Now, the Tobin Q is interested in firm value. That's all. So the only difference is firm value. So now what do we want? We want the market value of firm, replacement cost of the firm, of the assets, the firm. So it's very similar to the PB ratio, right? So what happens here? If the Tobin Q is more than 1, is overvalued, less than 1, undervalued. So as mentioned here, PB is related to stock of the company, while Tobin Q is the total value of the firm. Tobin Q is usually used for acquisition, mergers and acquisition. Because when you're acquiring a firm, you are interested in the cash flow to firm, not cash flow to equity, right? Because you're getting the whole firm. A Tobin Q is less than 1 is likely takeover candidate. All right. So we have one more ratio, which is the price to sales. Remember right at the start, I mentioned that, hey, you know what? If the earnings is negative or zero earnings, then the PE ratio might not make so much sense. So we can use the price to sales ratio. So price, of course, is the stock price divided by total revenue. So this ratio is the actuals, right? However, we again need to calculate what's the justified. And we remember we're doing a comparison between actuals and justified. So how do we derive the justified PS ratio? We again start with the growing perpetuity. We know it's D naught equals 1 plus G. And we know D naught or dividends at year 0 is the earnings at year 0 times 1 minus retention. So earnings times the payout ratio give you what's being give you the dividends that's being paid. We also know that earnings at equals to sales times net profit margin, right? Remember, net profit margin is what? It's net profit divided by sales, right? And if we multiply by sales, we get the net profit. So we know, so you get net profit here. So earnings is sales times net profit margin. And once we get this, we divide both sides by sales. You get the PS ratio here. And then because we multiply both sides by sales, this cancel off. This gets divide by sales. And this get cancelled off, divide this by sales, we get net profit margin, and we know net profit margin equals to right. And so that's how we derive the justified PS ratio. And this is what we need. So key determinant of the PS ratio is the profit margin here. Okay, let's look at some advantages and disadvantages. Sales is easily to manipulate, sales is less easy to manipulate compared to earnings and book value. Why? Because sales is sales, right? There is no impairment in the sales, there is no funny things that happen. Of course, it's not resistant to manipulation. You still can manipulate sales. And one way, not sure whether everyone know, but one way is you can sell in arrears, right? Sell forward. So what a lot of company like to do, not like to do, but they do sometimes is they push distributors to purchase the product. So for example, if you're a manufacturer, right? I manufacture cars, right? And then when I manufacture a car, I sell it to a distributor. Distributors sell my car, right? As a manufacturer, if I want to increase my sales, what do? I force the distributor to take on more cars than they can actually sell, right? So for example, they only need 10 cars per year. I force them to take 20 cars per year. They can keep it in their warehouse, whatever, I don't care. But if I have enough power to force the distributor to take on the cars, then I can increase my sales because I am, as a manufacturer, I'm recognizing 20 cars sold. So that's how sales can kind of be manipulated as well, right? But of course, it's a bit more tricky to do it. You need to have enough power, bargaining power, the supplier. Of course, revenue recognition may be different. I hope you remember or kind of like your revenue recognition principle. Like if it's a not manufacturing, construction. So construction company generally recognize revenue based on percentage completion of a building. However, determining what percentage of the building is completed is very tricky, right? It's not a clear-cut assessment. So you can say 20% of the building is completed. How do you know it's 20%? Why not 25? Why not 20, 23 or 30%? Right? So because of that, the amount of revenue recognized can kind of be different and can kind of be manipulated as well for like let's say a construction company. Sales is always positive, less volatile than earnings, which is good. Empirical evidence shows that PS is related to long-term stock returns. So we can use PS to value stocks mature, cyclical, and zero income, right? Especially zero income or negative income companies, such as, let's say, startup. So high sales does not mean positive EPS or positive cash flow. Remember, sales and cash flow are different categories. You can have positive sales and negative cash flow, and your company will become bankrupt. PS ratio does not reflect the difference in cost structure. What's cost structure? Cost structure is the debt slash equity. Okay, it does not show the difference between debt and equity. The amount of debt or equity that the company holds. Okay, so we have an example here. We're given stock price, EPS, dividend, book value, sales, ROE, return. So we are asked to calculate actual, right? Price, PE, PB, PS, right? So I hope this is not difficult. We just plug in the values, as you can see here. So price divided by earnings, price divided by earnings, price divided by book value, price divided by sales, right? Given the question. So actuals are generally quite easy to calculate. Now, to calculate the justified one, here, it gets a bit tricky because we need to pick the right formulas to use. First, price to earnings. We call price to earnings. We need to use this formula, and with this one, we are using a trailing P ratio, trailing justified P ratio. So we can calculate the dividend payout ratio. Let's feedback. We know that we pay out 1.2, and the earnings per share. Let's see what's the earnings. Earnings per share is $2. So we know that from here we can calculate what is being paid out in terms of payout ratio. Calculate what's the retention ratio. We can calculate the sustainable growth rate, and from here we can calculate the P ratio based on this formula, the PB ratio based on this formula, and the PS ratio based on this formula. So having calculated these three ratios, what do we conclude? So we see that actuals are more than justified. Actuals are more than justified for PB. They are actually all the actuals are more than justified for PE, PB, and PS. It means what? It means that because the actuals are more than the so-called the benchmark, it means that the stock is overvalued. That's how we conclude a overvaluation. Any question on this example? This example is a very good, like comprehensive example of how we use the three ratios, in this case, three ratios to do a conclusion on the company. And if you do use relative valuation for your for whatever case, you need to ensure that you use multiple ratios to complete. Okay, so the actuals is based on I won't say historical. Remember, because we can have a case of a forward PE. Remember, forward PE you're using forecast as well, right? So how I would think about it is that the actuals are based on financial statement. The justified is based on discounted cash flows. Remember how we derive it all from the Gray perpetuity formula. That's how I think about it. And, and your justified is like a benchmark, and your actuals are what you compare it with actuals. Yeah, you can use the data to do so if you are using, let's say you want to calculate forward PE, right? So for PE, you need a forward earnings. And so you can use the current to come up with some forward figures, and then you use the forward PE for actuals. And then in terms of the justified forward PE, we call for justified forward PE, we need the growth. So we can use the you can forecast the growth for the forward, and then you can calculate the forward justified PE. All right. So I think that's all for today. Yeah. So that's all for today's lecture. We do have some self-review questions. I encourage you to have a look at it. Of course, you already know the final assessment. It's nothing related to all these examples, but they will help you understand how comparison of justified and actuals actually work, and actually how what figures to plug in or your calculation of the ratios. So I encourage you to have a look. And you know what? Now let's maybe we take a quick 7 minutes break. We come back at 9:10. And then we cover the last two part, which is the GBA, as well as any clarifications for any part of the course that we've covered so far. All right. We'll feel free to put any questions if you do have during the break. We'll come back at 9:10. All right. Okay, welcome back. Last part of today's class. Hopefully this part can be a bit more interactive in the sense that I highly encourage you to ask any questions. So we'll try to tackle the GPA first. At the same time, you know, along the way, if there are any questions relating to any topics in particular that we have covered in the last 6 lecture, feel free to stop and we can try to discuss any questions related to it. So I'll put a caveat that I think some students have emailed me regarding questions relating to the ECA. So, I'm not sure whether you know, but in year 3, as of all courses, instructors are not allowed to answer any questions relating to like clarifications, like for example, how many years should we use for this and that, these kind of things for ECA, right? Because ECA is the final exam. So we can answer clarifications like, the requirement of this question. I think there was announcement posted about the requirement for the presentation and the requirement for the slides. So like this kind of things we can answer, but we can't answer like, should I choose or should I use common share? Should I use preferred share? This kind of things. Unfortunately, we are not allowed to answer to ensure that it's fair for all classes for the finals. And yeah, just want to put it out there in case some of you might receive email from me and say, "Oh, I'm sorry, I can't reply this part of the question." So generally, I think in terms of the GPA, most group did very well. I think the average for the class is close or more than 70 marks, which is quite good. I know there are some groups had quite a bit of issues relating to free riders. So I hope that will be resolved from the school's level. And if they didn't, do drop me an email so I can remind them again to do the moderation on their side. So in the GPA, you'll realize that I have put a lot of remarks because I know what you have covered in the GPA will likely help you in your finals as well. At the same time, overall, I would say we have 9 groups. I think okay, if you need a reference, this is up to you guys, right? Whether you want to share or not. But I know a few groups did very well. I think group 2 did very well. I think group 9 also did very well. And so I think their reports are like a very good standard to look at. So if you do know any members from group 9, to I think there's one group also did very well. And a few of them did quite well. So try to reach out to them and if they are willing to share their hard work, yeah, can kind of benefit from it. So yeah. Okay. So what I want to go through for the GPA, first, any questions relating to the remarks in the GPA? I think there are no questions. So maybe I will just quickly run through the questions and then we can look at a bit on the annual report as well. And let's try to understand and study the annual report of the company under the GPA. So I also want to highlight that for all the groups, I think everyone did SIA except one group that did SEMCOP. Unfortunately, I think the group that did SEMCOP didn't score too well because SEMCOP, I think I mentioned, is a very difficult company because they have many segments. So you need to really do the segmentation when you do your qualitative analysis. If it's okay, can we focus our discussion on SIA or do you want to do both SIA and SEMCOP? SIA. Okay. Okay, for beta, unfortunately, the it's usually using regression to calculate the beta. Yeah. Um, yeah, fortunately that is the right way to do it. Okay. So we can focus on SIA. That's the same. For the group that did SEMCOP, if you do have any clarifications on SEMCOP itself, do drop me an email. Like I mentioned I think at the mid of this course, when I was working in Singapore, I actually covered both SEMCOP and SIA under my portfolio as a corporate banker. So I kind of know the company inside out. Uh, and I don't know whether it's a unfortunate thing, but it means that um, you need to be very you need to really read the company carefully, all right, when analyzing them, because there are a lot of small things that will impact your valuation. Okay, so let's just read. Okay, so you join this research company, you want to recommend this stock, right? Um, there's some risk-free rate and market risk premium. I want to highlight that the group that did very well, I think they went to they actually read through the additional questions that was posted on our tutorial group on how do you actually calculate market risk premium, right? And they use the country risk and all. And I think that was like super good. I think they got the full marks for that portion of the calculations. Risk-free rate, some groups also did justify that they use a different rate, which is good. If you do not, that's fine as well. There is no mark deduction on that portion, right? If you use the question given rate. Before that, I want to highlight that I think even for your ECA, there is marks given. I think because I've not, there's no, yeah, it's not released to us the marking scheme yet. But similar to your GBA, there will be marks given for formatting, for flow of report, and marks given for uh, concise and language. So, and it's quite substantial. So for your GBA, it's 15 marks, right? So it's quite a substantial component. So I highly encourage you to, just format your report properly. Just a couple of things, like before we go into the details, is that um, for for executive summary, generally is one page. If it's your executive summary is 3 lines or 4 lines, that's not executive summary. So at least it's half a page or 3/4 page or 2/3 page. That's a good executive summary, right? So these are formatting marks. So and your executive summary shouldn't have diagrams, pictures, pictures, graphs, right? So executive summary is really a summary, and your executive summary should focus on valuation, right? So not an executive summary of SIA. Since in this GBA, you're doing executive summary, it's not about SIA. So you do not summarize what's SIA, right? It's a summary of your valuation. So, what parameters you think considers important, you have used this and that, you have did a industry analysis of SIA, you did a economic analysis, just few points. And then you at the end you must have a conclusion like, okay, so the executive summary we recommend to buy or recommend a sell call or whatever, right? So those that part is the part of executive summary that I want to highlight is important. At the same time, for formatting, we should have a conclusion as well in the end of your report. So conclusion meaning that you need to conclude, right? Even though the report doesn't say conclude on something, you need to conclude like, okay, based on the qualitative, quantitative evaluation, maybe you do, if you recall what I did for Spandex, I think the company, there is a football field kind of analysis. You can use that, you don't want to use that, it's fine. But that's kind of like a good way to conclude, right? So based on this, we have placed the company here, and we, based on our positive outlook, let's just say, we recommend a buy call, right? So So a conclusion is important because that will give you formatting marks as well. Okay. Let's see. And okay, one more thing before I answer the question is regarding the formatting is that I know a lot of groups put quite a lot of parts in appendix, which is good. So appendix supports your main report. But remember, your appendix is supposed to support your main report. But in your main report, you are supposed to also explain certain things, right? For example, if you use market value of that, market value of stocks, you do need to explain it, right? So, for example, in the main report, you say, oh, you have used the market value of that, of this, by obtaining the numbers or the market price of the bonds and took an average of this for the year, something like this, right? So you explain it in the main report, and in the appendix you can do, I don't know, a screenshot or like uh screenshot of, like, let's say Yahoo Finance of the bond prices, or you do a screenshot of the bond price in the financial report. So that's how the appendix supports the um, uh, main report. However, it shouldn't be in the sense like, oh, we use market value of that of $100. We use market value of equity $200, right? And then they say refer to appendix for details. So there is no explanation, right? How do you get the market value? This kind of thing is like more of the formatting that would actually contribute quite a subset, 15% of your overall grades. Okay, so we have a question here. Okay, so yes, you can put it in the first page as executive summary. At the same time, you also want to, like I mentioned, do a conclusion at the end, right? As conclude on your recommendation. So yeah. Okay. So this is the portion here, right? You'll be assessed on the report content and quality of the report. So at the end of the day, like I mentioned, I think group who did very well in terms of the formatting and everything, where the executive summary was on top, and then they bring in various components. Of course, you making sure they answer the questions here. Um, and course quality, this is quite a big component. It's easy to score, right? I would say that if you make sure that you do it, format it well, it should be good. I feel that overall, part A and part C has been done really well. Part B, most of the group struggle in part B. I want to highlight that there is one or two groups did the calculation of the ratios here, but did not do any explanation. So unfortunately, if you did that, you would likely only receive half the marks because the other half relates to explaining the ratios, right? Doing your analysis of the ratios, and that part is kind of the important component. And I think most of the feedback I'll kind of point you to this slide. I want to highlight the importance of doing a financial statement analysis is very important. So things like this, compare balance sheet items, determine what constitute a large percentage, do some comments on this, compare the ratios, um, bring in some political, social, political, economic factors, bring in the context, use the economic and industrial analysis to explain the variance, comment on any one of exceptional items, the impact of impairment, and write-off. So this part is, I think, quite pertinent, and I think most group lost like maybe 3 to 5 marks depending on the extensiveness of the comments on financial statement analysis. So, at this point, maybe because I want to talk about more the financial statement analysis. So, a question: do you want me to talk more on financial statement analysis, or should you want to go more on the valuation component? Can do both. Okay. Okay, then we do the valuation first, and we have time, then we do financial statement analysis because that part is quite. I mean, it's 15 marks. This part is okay. So some say on valuation. Okay, let's do valuation first. Also appraise this component. I think most people got the full marks. Should be no problem with this. You just comment why you choose. At the end of the day, so I want to highlight that there is no right or wrong answer. I think I accepted both FCFE and FCFF depending on how you justify. I think nobody used dividend discount for this case. Okay, so this component on cost of capital, I want to highlight most people use the market value of equity, which is good. However, for debt, I think most of the people do use the book value of debt, meaning book value, meaning the debt amount that you got from the financial statement. So I want to highlight that this is incorrect. You need to use the market value of debt. And how do you calculate market value of debt? You need to look at the market value of the bond prices. If your debt is consists of bond, sometimes if it's a mixture, then you can justify like, oh, okay, I use for the bond related debt, I use market value bond. For the non-bond related debt, I use the because you're unable to find the market value, you rely on historical value based on financial statement, something like that, right? Then that comment would be correct, right? But if you just say I've used the market value of that, but you plug in the financial statement value, then there's no justification of why you say market value but you use financial statement value, and then that's not correct. I also want to highlight that to calculate cost of debt, I think most group, I think 90% of the group did it very well. You use the time value of money. You use because remember there are three methods to calculate cost of debt. I think one or two groups use the interest expense divided by total debt, and there were a few clarifications on it. I think before the GBA submission, I also mentioned that we cannot use that method in finance. I'm not sure where you learn this, maybe in other accounting modules or maybe level 2 finance module, but for this module or the idea of valuation, we cannot use that because that's totally wrong. Totally wrong in the sense of value for valuation, but maybe you can use that for accounting and these kind of things. Any questions for question 3? Any clarification required? Okay. So remember, feel free to stop me, because we hope this would be a good kind of way to clarify any doubts you have for your finals. So question 4. Okay, so question 4, you notice that it's 30 marks. So while you have done, let's say, a good report for question 1, 2, and 3, right? And let's say question 4, you just write 4 lines. Oh, we recommend a buy call based on the analysis done in question 1, 2, 3. 1, 2, 3. Unfortunately, you will not be able to get most of the 30 marks because it's quite heavy, this part, 30 marks. So it requires includes an executive summary containing key data. So when they say key data, you should not you include like you can mention percentages and all, but not like figures. Okay. Investment thesis, target price, investment horizon, total, so target turn, justify parameters. So in some point, you could have already mentioned a lot of it, but I believe you will not have mentioned things like so choice of valuation method you will have mentioned in part two. Parameters you probably mentioned in part three, right? But part three relates to WACC, so you do need to mention various parameters, why you choose certain parameters for your FCFE calculation, right? Your terminal value component, etc. Whether you do stage one, stage two, two stage or one stage, you need to justify that. So those will give you the part of the 30 marks. Because exactly summary as well. Investment thesis, this is basically to explain, if you can do I think it'll be good if you can do a peer analysis. I did not see that in any of the report, but it will be a very good value add for question 4. Do a peer analysis to say that, hey, you know what, in the market compared with other peers, maybe SIA is a buy call, it's a strong buy, something like that, right? Because others is being overvalued, but SIA is like really undervalued, if that's what you found. Okay, any questions for this? Okay, regarding the FCF, one to take note is that you need to calculate the G, sustainable growth rate. So I think maybe 50% of the groups did the calculation and explain how it's been calculated. That's very good. I think the other 50 did not. So this part you kind of lost mark in terms of um, the justifying your parameters, right? You just plug I don't know, a G from somewhere. You just say G is like this. Uh, yes. So for I think there is a question. So for the order, logical order, and ties back together, this to mention summary. Sorry, executive, summary, and conclusion. You need both of it. Yeah. Yes. Okay, so you can still put your questions regarding GBA. What I would like to do now is I want to share my screen on my computer uh, on the financial statement of SIA, as we have agreed to focus on this. Okay, so I'm sharing my Okay, so I'm sharing my screen on SIA now. I want to just run through how do we look at a financial report. So unfortunately, I think this part of the course did not really talk too much on, really how do you understand and read a financial report. Maybe they assume that you already know this. And of course, if you do, please stop me so we can spend more time on other things, right? And discuss other stuff. Okay, so when we look at financial report of SIA, and in a sense of your GBA and others, let's so go to school. Okay, so we have a lot of information. Now, let's just go to the financial statement first, then we'll jump back to all those information here. So we have many questions regarding, okay, should I use the group numbers or should I use, let me just scroll down. the company numbers. Sorry, these are all group here. See, there's group and company. So I think as highlighted previously, we should always focus on the group. Now, I want to explain why. So what does the difference mean? So a company means that you are just looking at SIA itself, the company, right? SIA company. Group means you're looking at all its affiliated companies. And why is this important? Let me scroll down to this part on the group structure. Here, can you see here? See this part on group structure, there is actually a lot of companies that are not SIA limited, but they are like all the companies here. So when we're looking at group, right, means that you're considering all these companies, which is actually what we want because the market values SIA as a group, not just SIA limited, which is what if you're looking at company alone, is SIA limited. Does that answer the question? Because I think I received a few questions regarding this. So I hope it makes sense, right? What's group and what's company? Okay, so what else I'd like to comment? Now, unfortunately, remember when we talk about lecture one, all the way back lecture one, I think I did mention a bit on this point called shareholding. Anyone recalls about shareholding? This talk about shareholding. Anyone recalls like what should we talk about for shareholding? Number of share, okay. Not really issued share, yeah, okay, James, you're right. Yeah, key shareholder, that's correct. So I this part is kind of missing, but luckily there is no marks given to it. Like in the marking scheme, there is no marks given to shareholding discussion. But I want to highlight that it can be a very important component of your discussion, especially when you do your summary, right? Your investment thesis, because you can bring in all these ideas, right? And why is it important? So, like in your GPA, which requires you to talk about investment thesis, if you notice, when you study the shareholding of SIA, these two shareholder, Naples Investment and Temasek Holdings. So, a background, Naples Investment is part of Temasek Holdings. You can Google and you can trace the shareholding. It goes through a few layers, but it traces back to Temasek Holdings. I think it's explained in this somewhere as well below here. Yeah, that your direct and deemed. So your total share interest of Temasek is actually 55%, which is more than 50%. Meaning what? Temasek has a very strong backing of SIA. So, you know, as a value, let's say if I'm doing a valuation of SIA, I will be very confident because I know that Temasek is government linked, and you know that the Singapore government would not allow SIA to fail, right? And then you can bring ideas of, hey, you know what, during the COVID period, they actually encouraged the issuance of mandatory convertible bonds, which was supported, if I'm not wrong, by Temasek. It was they provided some backing for the support of SIA at that point of time. So, bringing in these kind of ideas would support your investment thesis, right? Now, there's one more thing that I would like to highlight here. There is one special share held by Ministry of Finance. So this component is very interesting. You know why? If you do a search, right, I think it's in the notes to financial statement. So that's where, okay, so this part of the discussion here is where your analysis of the company really value adds, right, to your investment or your valuation statement. So if I do a, let me see, special share.
Hi, Prof. Sorry, can I just check, right?
Yeah,
For
sure.
the number of outstanding shares, right? Because you mentioned here that it's about 2.97 billion shares, right?
Yeah,
And same for Yahoo. But then let's say we'll go to Cap IQ, but then they give us the information that the shares outstanding is about 5 billion.
yeah,
So was wondering, is it because they converted the
yeah.
what, the convertible?
The
So
mandatory convertible bonds. Yeah.
yes. So in that case, right, in our valuation, do we actually use the 5 billion or the 2.97 billion?
Okay.
Or it depends on our
So
stance of how
I think it
conservative we want.
depends. No. So I think, yeah. So okay, you're right. Depends on how conservative you want to be. And because you know they are already converted, right? So I would encourage you to look at the half-year financial statement for this year. I believe they're already converted because I was reading a financial statement. They say confirm converted. So if they are confirm converted, then from a valuation perspective, you should assume that it is being. Yeah.
Understood. But then like for Yahoo Finance, they are still having it as 2.97 billion. So could that be reflected as the most accurate information?
No, then it's not. So you might want to check the half year financial statement. Is it still 2.9? I think it's not. I believe you might want
Okay,
to check
understood. I will go check the half year
the half
financials.
year. Yeah, that would
Thank
be a good gauge. Okay, thanks for the question. So just now I mentioned about this special share. I want to highlight to you about this. Can you see this? So the Ministry of Finance, of course, and it's a Ministry of Singapore, has one special share, and they say that no resolution may be passed on certain matters without prior written approval from a special member, meaning the Ministry of Finance. This gives you very strong backing to say that, hey, you know what? SIA will never go bankrupt because you have the Ministry of Finance, which is like the ministry with all the money, supporting this company, right? And has a special share in the company. So this one share is better than, it's as if saying this one share is better than this 2.97 million shares in that sense. So this is an important thing to discuss, I would say. Okay, G, what is the CAPR? What's CAPR? Okay, for G, I would recommend to use the calculation, the ROE times the retention ratio. So try to use that for the sustainable growth rate. However, you can compare the ratio and calculate the G based on this calculation with what you got from, let's say, Yahoo Finance for the G to see whether your calculation makes sense. Because most of the time, if you use things like Refinitiv or S&P Capital IQ, they will explain to you how they calculate the G. But most of the time, there's a lot of adjustments being done. So you just want to make sure that you are close to them. It might not be exactly the same, but just close enough. Of course, if your growth rate is your company, your calculated rate is 100% growth, right? Then that one is a red flag, so you need to check. Or is 80% growth, it might be a red flag as well, depending on the situation. Okay, so I think, yeah, this question I can answer. Uh, and I think somebody also emailed me and asked. So you can use also information provided. You should use information provided in the question as well as you can also bring in external information to support. Yeah. So you should use information provided in question one, but if you feel that there's a lot more value add to bring other information, you should again. Yes, so for the G, all the G's are the sustainable growth rate for MCFE, SCFM, and DCM.
Hi, Prof. Sorry, just a question. For this
Okay,
sustainable growth rate, right, that you are talking
yeah,
about, like how do you actually apply it? I'm a bit confused. Like, to which part of the
okay.
valuation is it used to apply?
Okay, so usually it's applied at the terminal value, calculate terminal value.
Sorry? Also,
Uh,
in the it applies the terminal value, right?
yeah, usually
Yeah,
it's only applied at
understood.
terminal value.
Let's say we are to use, like, so for my group we use the I think the 50 years of the growth
Mhm.
for Singapore. Would that be like a
Mm,
justifiable growth rate?
I think it's okay, but then 50 years
Very
might
too
be a bit too
conservative.
long. Yeah, like a bit long. I
Uh,
would do like 10, 20 years, because 50 years things will change. So you're pulling in a lot of noise into your data.
Understood. Thank you.
Yeah, yeah, most welcome. Okay, so we do have some questions here. Okay, look at dividends component. Would it be right to take the gross dividends, consider both interim and final? Okay, let's look at dividends. So remember, we are very interested. So don't just look at the financial statement. Look at the notes to financial statement to understand. So what's happening here? Following the tax exam, dividends were declared and paid by the company with respect to this date. So they proposed this amount of dividends for March. So no dividends was declared or paid for the financial year.
Sorry, can I just check? So in
Mm,
this case, the dividends, is it considered 38 cents or is it considered 28 cents? Or is it 10 cents?
yeah, this is very tricky. Let's see, 28, 10.
Because the total they said is 38, but I think one of it is final, one of it is interim.
Yeah, because there's 28 and then there's a 10, right? Uh,
Mm.
It feels
to
like
be
maybe
paid,
10 only though, because the number is like 297. It's like very nice.
But
yeah,
in
and
accounting sense, right,
and
it
this,
makes sense to consider both because he already, if the group already declared, technically it will be paid in the future. But in
correct.
financial year ended 2023, right, it actually accounts for it. So I will assume to take both like
So for valuation purpose, we take in both, right?
Yeah,
I
we take both.
assume,
Yeah,
okay.
so this is I think what we discussed previously, whether you want to be conservative, right? So this one you can see they say they propose, but to be paid end of March 2020, March 31st. So it's next year already. Um, and I just want
But it's
to,
within the fiscal period, right?
yeah, it's within,
Fiscal
yeah,
year.
because the fiscal is in March, right?
Yeah.
So yeah, so we should take 28, and then this one is a interim in of 10 cents. Yeah, so we can take 10 cents. I would I would encourage you to go back to the last financial statement to see whether they did mention this 10 cents that was being declared and when was it paid. So the last financial statement would have right when it's
Mm.
being declared and when it's being paid. So I would encourage you to do that, because if I was doing a revaluation, I was like, oh, okay, so I want to check when was it declared and paid for this. Yeah,
Okay.
but it should be taken into account. Yeah,
Hi,
please do.
Prosper. So does that mean in this case we have to add the 297 million to the 831 million?
Yeah, yeah,
Okay, understood. So that would be divided by the net income if you want to get the dividend payout ratio lah, instead of just
yeah.
using 297. Okay,
Yeah.
understood. Thank you.
Okay, so look at the, okay, for computation, like question 3 figures. Yeah, you can, for computation, like question 3, of the GBA, yes, we can use the best as of 31st if you want. However, it's not wrong to also use based on your valuation date, right? The date that you want to set your report. So, for example, if you're writing a report, let's say November this year, for the company in March, right? So, certain values you might want to use uh, the current date. So, it really depends on how you justify, right? Because remember, you're doing it now, the valuation now. So some of the values might make sense to use as of 31st March, right? For example, if you're doing adjustments to your financial statement, and you're reversing the depreciation, let's say, or impairment, you might make sense to do it as of 31st March, right? However, if you are thinking about things like, okay, if I want to calculate uh, the price of the share, right? So price of share, you might want to take it as now, right? What's the price now? Current price, right? So it depends. So not everything must go back to 31st March. It depends on what other items that you're computing. Okay, so if you quote the growth rate based on financial side, you can say, okay, based on, let's say, Refinitiv, your growth rate is, calculated growth rate is 3%. Yes, okay, you can do that. However, you need to justify in the sense, okay, why do you think this growth rate is correct? So based on the calculations in Refinitiv, we believe that this growth rate matches the industry peers, or the calculation used in the growth rate um, is usually they will tell you how they calculate. Is like ROE times retention ratio times some plus something, because usually they do some manipulation and stuff plus something, and this would make sense for the company, something like that. So instead of just plugging the numbers, you need to make a few comments, right? You need not make so like detail and try to explain like, the whole model that you use, but just explain some detail that you find. So this will help you justify. Uh, I hope that answer the question. So you can actually plug figures from various financial sites, but you do need to bring in some why you think is correct. Yeah. So it's not just okay. Yahoo Finance says 5%. I just take 5%. Right. We must say, like, oh, okay. Maybe you do a bit of analysis on yourself. Right. It's like, oh, based on this is kind of the median for this industry, and so this makes sense for us. Something like that. Okay, so I think we have a question regarding DDM. Are we expected to justify? Unfortunately, I think this is one of the questions that, okay, so please just read the question carefully, like, you know, to avoid being unfair to other classes. Like, can't really answer that, but just read the question carefully, see what the question wants, look at the marks, right? So if it's substantial, you might just want to write something, right? So just, yeah, I'll encourage you to look at the question very carefully. Okay, so one more thing, right? I want to highlight to here. You can, yeah, if you have more questions, just stop me. I want to highlight that something was a little missing in a lot of the analysis is this part here. Okay, so very good that they provided financial statement analysis, and I surely encourage you to try to reference to what they have written, but do not take everything wholesale. Why? Because of course they will always say good things about their company, right? They will not say bad things about their company. So I want to highlight something here. Okay, here. I think not many people commented on the revenue split. Can you see? Like, I know that quite a few people in the financial statement analysis say, hey, you know what? cargo revenue has deteriorated, has dropped, it's very bad, it's not good. However, I want to highlight to you how what is the percentage of revenue stemming from cargo. Actually, it's not a lot. It's 3.6 divided by 17.7. Most of the revenue comes from passenger flow revenue. So as a valuation analyst, you need to be careful. You can say like, okay, yes, cargo revenue has dropped year on year, and this drop is 17%. However, it stems largely, it constitutes, let's say, I don't know how many percent here, maybe it's 10%, maybe 20% or 20% or 15% of the total revenue. And therefore, it is not substantial, something like that. So you want to shift your valuation. If you have a positive valuation, you want to shift it, right? Yes, it has dropped, but don't stop at it has dropped. Say that, oh, however, it is not substantial because bulk of the revenue comes from passenger flow revenue. And overall revenue has increased year on year, let's say, by this. All right. So another thing I want to highlight here is segment revenue. So also not many groups went to the detail on this part. So this part is quite important part. Segment information. So segment information tells you where all the items are coming from, and we should look at the group level segment as they even explain to you, okay, what segments are low cost, engineering, etc. So you want to dissect the information. So this is a total consolidated revenue. Can you see most of the revenue comes from full service carrier? Engineering service is so little. So what does engineering service constitute? Fleet management, etc., cabin repairs, overhaul. So, look at the segment information because that is quite interesting. One more thing I want to highlight is this thing, geography segment. So when you do your what's the equity risk premium, I think some groups did very well. They brought in the revenue split, and therefore they use various regions of country risk premium to bring in. So this is one area where you can know the percentage rather than doing a simple average. You can do a weighted average, right, based on the revenue split. Everyone understand this? This is a good part that we can. I think one group did try to do a country risk premium, but you can improve it by doing a weighted average based on this. Of course, these are not full countries, so you need to do an average of the region. Yes, okay, so there's a question. Can you bring I want to highlight to you the ECA. Please read the question very carefully. You might think that they're very similar, and they are, but you need to tweak like how you answer, because sometimes, right, when you answer the question, of course, I want to highlight that you do, like, let's say if they ask you to use uh if they really say a method like uh cash flow from equity, right? Free cash flow from equity. They always say you must use free cash flow from equity. So try not to spend time explaining what is free cash flow from equity, why you need to do this. You do not need to define and all those things, right? Those are expected that you can't know. So answer directly the question. If they say use free cash flow to equity, then yes, use free cash flow to equity and explain whatever they want. So just read the question carefully and answer directly to the question. That's what I want to highlight. Then the good thing I think is that there is no word limit. So of course, don't write like writing a lot doesn't mean more marks. I don't know if you know that, but at least it doesn't force you to write less. So you can bring whatever you have done in the GBA. So that's why I say, I know there are some groups that did very well. So it is if you are friends with other people from other groups and you like to share, that would be great because they can use your your input. But at the same time, also because the companies are the same, this is the first time. I think it's the first time in this course that companies are the same. Normally, it's not. So this is the first time. I don't know why because it's the same. Therefore, I don't know whether the groups want to share that information because I think some groups put a lot of effort. They really do like regression and they did all the analysis very well. So it's up to you whether you share. No, there's no page limit. I think. Yeah, just focus on answering the question. Yeah. Yeah, but I write very long, so it really depends on the quality as well. So yeah. Yeah, yeah. 6 minutes presentation. And remember the presentation criteria as mentioned in the announcement, right? So please take note of the presentation criteria. So I think we are out of time. Let me just stop the recording. I think we're done.